That December 15th, as you point to, is such a crucial date because we start to ask ourselves, if phase one is not done, what will President Trump do? Will he still, as an act of goodwill, pause those tariffs, or will he increase them? If we see an increase in those tariffs or any signs that there might be an escalation or talks deteriorating, do you get a sense that investors who, as you said earlier, have been putting money to work in EM, in Europe, in China, are going to quickly take that money off the table? Or have they not been putting money on with such conviction that they'd be willing to leave it there?
There's a great question, and to answer that, we have to look at positioning of some of those exposures that have been seeing inflows so far this year. I give you one example. European equities have been very much impacted by global trade headlines so far this year, and more recently, over the course of last 2 months or so, we have seen inflows. But if you think about year to date, we're still talking about slightly less than $100 billion of outflows coming from European equity funds across ETF, index mutual fund, and active strategies. So even though we have seen inflows coming back out, it's from a significantly under-owned position. And in fact, European equities so far this year is turning out to be the dark horse this year because performance has been good, positioning is extremely light, and it's turning out to be a big pain trade, which is why we see investors catching up now. And should the tariff kick in on the 15th of December, which is not looking likely at the pace at this current rate. If that were to happen, investors are still significantly under-owning these exposures. We don't know how much it could come out, actually.